Okay, hopefully everybody can see that. So
Yep.
just very quickly, those of you that don't know who I am, that's a bit of background on me. So currently I'm the principal of Nivas Real Estate and also double hat as Chief Risk Officer for Norwest Funds Management, which is a boutique funds management company. And I've had a long career of about 30 plus years in banking, most of which has been in global markets and in global finance. So in those jobs, I have had quite a lot of exposure to regulators. Been in a lot of forums and committees, industry committees in Australia, and have had quite a lot to do with the economy and what really makes the economy tick. And what implications that has to the property market. So hopefully today I can give you some insights into what is happening in the economy, what things you need to look out for, and try to decipher some of the noise that is in the marketplace at the moment. But tonight, mostly we're going to talk about the Adelaide property market as well, and give you some insights into why we think Adelaide is a good place to invest right now. Okay, in the last few days and weeks, we have, as I said, a lot of news on a number of things. Interest rates is very topical. So on the left here, I've got some of the news that are negatives for property. And on the right here, I've got some of the news that is positive for properties, okay? Now, interest rates is probably the biggest factor at the moment, be it at home here, where it's now 1.35, and we've been told there is more to come. And that is on the back of higher than expected inflation. We'll talk more about that shortly. US Fed increased another 75 basis points last night, if you haven't heard the news. So they're now in this range here, 2.25 to 2.5. They don't have a fixed rate. They don't have one rate, rather. They have a range. And that's the range that they use for the interbank market. US inflation is at 9.1%. There's recessionary fears in the US, which has had some negative impact on the stock market over the last 3 months. And the last few days, mind you, it has sort of bounced back a little bit. So we'll see how these negatives actually play out. And there's a lot of factors that impact those. On the right here, some positives. I won't read out all of them, but one of the big ones for our state in New South Wales is that they want to get rid of what Dominic Perrottet calls the worst tax, which is stamp duty, and they're going to replace that with some form of land tax. And we have got a major rental crisis in our state and across all of Australia at the moment, which is coming in the news every week. Labor figures, unemployment figures, I should say, is at 48-year lows at 3.5%. Okay, this is an important number, as we will discuss more in the next slides. And then right down here, we've got the GDP growth. Our economy is, last quarter, it grew 0.8%. Will be interesting to see what that next quarter will look like. The numbers are going to come out shortly. So these are just some of the positives and some of the negatives. And so it's a question of how do you sort of take all this noise in the market and see that the real story is with the impact all of this is going to have on the property market. And I'll try to actually give you some insights today. Now, a little bit about my past predictions and in terms of the future. So in July 2020, I predicted that property prices will increase by 20% in 2021, when the rest of the market at that time, in the middle of COVID, were actually going -20 to -30. In July, August of 2021, last year, I predicted that interest rates will start rising in July 2022, and that you should not listen to the RBA governor because they often get it wrong. And as early as March this year, the Reserve Bank governor was still saying no interest rate increases until 2024. So it's hard when somebody of that stature actually tells you that there will be no increases and you are pounded with increases over the last 3 months. I, at that time, also asked all my listeners and clients to fix the interest rates out to as long as they possibly could using the lower interest rate environment that we had for fixed rates at that time. Keep in mind that fixed interest rates are not actually set by the Reserve Bank, and we'll talk a little bit more about that in a minute. Then in late last quarter of last year, I was continuously, in every webinar I did, I said there will be a major rental crisis in 2022. And that was because there were very few starts in terms of properties, mostly apartments, very few starts in 2020 and 2021 because of COVID and supply chain issues. So we were going to have a rental crisis because there was a supply and demand issue that was going to happen starting from 2022, and it's going to get much worse in 2023. Talk a bit more about that later as well. Now, in terms of price growth, so 2021, all of you know that we've had 25% increase in New South Wales. Adelaide has been bigger than that. Brisbane has been bigger than that. They've sort of outperformed in terms of Australia. But this is the 12 monthly change up to 25 July 2022, okay? So 12 monthly change as in, so last year to this year, 12 months to this date. Now, we haven't grown much in this period, in that period, okay? So Sydney is quite low, Melbourne even lower, Brisbane a stellar performer because they had strong growth through the second half of last year, and Adelaide by far the biggest growth, and they had a fantastic growth in the second half of last year, and still growing in terms of compared to the rest of Australia, it's still growing this year. And then smaller growths here. So we'll talk more about Adelaide in a minute, but this chart here is quite important to me, and I think should be quite important to anybody that wants to see what the key movers and shakers are, what factors actually move the needle when it comes to property price movement, okay? So the first one there is as I say, I call it economics 101, supply versus demand. Irrespective of the type of commodity you are selling, whether it is cars, whether it does not matter, to be honest. Supply and demand is probably going to be the number one factor. You know what has happened post-COVID with secondhand cars, for example, right? The prices have gone through the roof. And that's because there is no cars, and you got to wait for 1 year, 2 years for the car that you want to buy, a brand new car, to arrive in the country. So that has caused, a shortage on the supply side, and the demand obviously has been strong because people are saved up and they want to buy goods and services. So that is the main reason actually why we are having an inflation at the moment, okay? It's supply and demand. So that was very true in the 2021 period when interest rates fell to a rate that I never thought I would see in my career or in my lifetime, sub 2% interest rates, which pushed affordability quite high. And these two factors together actually caused the demand to go up a lot. And supply could not keep up with the pace of demand, and particularly true in the property market right across the board, okay? That is one of the primary factors that pushed the property prices up as far as it went. So land is a good example of that. And if you take Sydney or Brisbane or any of the cities, major cities in Australia, land values actually went up probably the highest out of all of the property classes. And in Sydney, I can tell you northwest of Sydney, southwest of Sydney, prices had actually gone up somewhere between 50% to 80%. Some of you living in the northwest of Sydney would know what has happened to Box Hill, Marsden Park, Riverstone, Rouse Hill, etc., and Kellyville, etc. So these two factors I kept saying throughout this slide I have been using now for the last 3 or 4 years. So all the talk is now about these two things, inflation and wages growth. Are we going to have wages growth? It's important to have wages growth when you've got inflation at such high rates. So we'll talk a bit more about inflation in a minute. Third one there, and this is in some kind of order, okay, in terms of what makes the property price tick. Regulation, very important. APRA is the key regulator for banks, and they dictate to a large extent the bank's lending policy, okay? So the macro level policies are set by them. The micro level policies are obviously set by the bank. What I will say to all of you today is that banks, 50% of their balance sheet is actually in mortgages. It is an anomaly in Australia that 50% of a bank's balance sheet is mortgages. This is not true anywhere else in the world. And I worked for HSBC for many years, and we've compared mortgage books around the world in 80 countries when I was working there with HSBC. And I can tell you that it is an anomaly for Australia. Now, they have a significant appetite. Banks here have a significant appetite, and they're quite cashed up at the moment to land in the residential mortgage space. To make the market tick, you've got to have banks' ability and appetite to lend to you. If they can't lend to you, forget about any property increases in prices, okay? And APRA needs to find the right balance. At different times, they have tweaked their policies with banks. At the moment, they have got a buffer of 3% on variable interest rates when they're assessing you on your ability to repay your loan. That is important. APRA is, through COVID and through the global financial crisis, APRA outshone every other regulator of banks around the world, and the rest of the world actually was looking at APRA to provide direction on why we have done so well out of the global financial crisis. I have done a number of talks to regulators, including APRA, on why HSBC's policies in this space has been better than the other banks as well, particularly to do with capital and liquidity. Now, the fourth one there is economy. The reason why everyone in mid-2020 was predicting that the sky will fall out in terms of property prices, and that was because of the predictions on GDP growth being negative for a sustained period and deep negative for a sustained period. We had a -6%, okay, that was bad enough, but the UK had a -25%. So we're nowhere near the UK. Unemployment, we were expecting, the RBA was expecting unemployment to hit 12%. It never did. We stopped at 7.5%, and now we're at record lows for the last 48 years. So these two things did not happen to the extent that the economists and the RBA thought it would happen. Okay, this is history now, but it's important going forward to make sure that these two things are in check. We are in a good place globally compared to other countries, OECD countries. We are in a very good place when it comes to unemployment and GDP at the moment. And that is why our economy is quite strong. Do not have to believe what Labor is saying, that they were handed a terrible state of the economy. Yes, we've got a big debt that was handed over to them, but these two factors were pretty good. Government spending, infrastructure, and incentives, that can move the needle on housing prices. And we have seen a lot of that happening through COVID to ensure that it is a construction-led recovery. So number 5 ensured that number 4 was in check, okay? So these two factors did well because of those factors. And we won't go through JobKeeper, JobSeeker. You all know the history. Number 6 is very important, extremely important for all my listeners to understand this point, okay? And I'm gonna spend 2 minutes trying to explain this. Delinquencies and loan write-offs is what causes house prices to go down the most. And what is a delinquency and what is a loan write-off? So I did say to you that half of a bank's balance sheet is actually in residential mortgages. That's a lot of the balance sheet. So if a major bank has about $900 billion of assets, then 450 billion of that is residential mortgages, okay? Now, if you start having a lot of delinquencies is if you don't pay your loan, your housing loan or your investment loan for 1 month, 2 months, 3 months, the bank comes and actually possesses your home after giving you notices and doing all the right things that they have to do. They'll possess your home and they'll do a mortgagee in possession sale. Okay, when you do a mortgagee, then when there's lots and lots and lots of mortgagee in possession sales and not enough buyers in the market, then you're going to have property prices falling by 20, 25, 30%. That is the only time that is going to happen. Now, I can tell you that Australians, and I've been sitting in risk committees for banks for many, many years. I can tell you that the amount of time we spend talking about mortgage write-offs and delinquencies of residential mortgages is probably about 5 to 10 minutes of a 4-hour risk committee meeting. It's because there is nothing much to talk about. Aussies pay their mortgages. When you have unemployment at 3.5%, guess what? If you can't pay your mortgage, you're going to get a second job, or your partner will get a second job. You'll pay your mortgage. Chances of this happening in a low unemployment environment is, in my view, quite impossible, okay? Impossible. I'm not saying you're not going to have delinquencies. Of course, you're going to have delinquencies. Of course, there will be some loan write-offs in the banks, but it will be nothing much to speak about. We talk more about credit cards write-offs, car loan write-offs, personal loan write-offs, commercial loan write-offs in banks' risk committees than mortgages. So this point is very, very important. In mid-2020, everyone thought that this part of the book is going to suffer, and all the banks took huge provisioning on that. They were all wrong, okay? Because the people who lost their jobs were not people who were owning homes. The last factor is very important as well. The supply chain issues have come through these two factors here, COVID and the war, majority of it. Of course, there's local factors, which is inflation is caused by local floods and cyclones and other things as well. But all of these factors, which are global factors, from time to time can have a significant impact on some of these other things economic-wise, which in turn has an impact on the property and the price movement, okay? Won't have time to go through it. There's a number of other factors I've left out, which is like foreign exchange rates and so on and so forth. When foreign exchange rates are low, it becomes more favorable for foreigners to actually buy here. So those factors come into play as well. But these, listen, it's in some, so top 4 are the most important, and then you've got those ones. Why did interest rates go up? I'm not going to go through this in any detail. I'll let you read the left side. What I will say is the last 2 years, it has been what I would say a honeymoon period, because we've had a pandemic and the Reserve Bank had no choice. They had one of the biggest levers to pull, which was keep dropping interest rates, because we need to stimulate the economy. We need to make sure people are still spending. We don't want to go into a recession. So they, for all of those reasons, they brought the interest rate down to 0.1%. This was only because of the pandemic. So for the media to come out now and say, well, you know, we've had a first interest rate increase in 10 years and make a big song and dance about it, there is no need for that. We're only going back to where we were in 2018 and 2019. So I fully expected, inflation or no inflation, I fully expected the RBA to go back to a sensible target of around 2 to 3%, which is where they want the cash rate to be, and that is where they want inflation to be. So if inflation is between 2 and 3, say 2.5, and interest rate is also at 2.5, that is the right place for us to be, okay? So keep in mind that this is a interesting graph that you should all be aware of, particularly those that haven't been in Australia for a long time, that the average cash rate has been 5% since 1990 to now. It has been at 5% average, okay? Yes, it did go up there in the late 80s, and then it's fallen. And we've had 4 increases here. One is here, the second one is here, the third one is a long one over here, and this is the 4th one. We've had 4 increases, and now we're having the 5th one since 1990. And I'll show you a little table in a minute with these 4 increases and what it did to property prices, okay? Now, very quickly, so where is it going to go from here? My take is that it's going to go somewhere around that 2.5 to maximum 3%. And we will probably see good signs by then of inflation reversing. And the Reserve Bank will be equipped at that point. And I think that point will be very late this year to early next year. So about 6 months from now, where I think the inflation will start reversing and there will be good signs. Now, these are the factors that are going to influence the Reserve Bank in terms of how quickly and how much they grow interest rates. Firstly, signs of inflation slowing and reducing. Signs of spending slowing. So if retail sales figures come out in a few days and you find that retail sales are down, GDP number comes out for the last quarter and you find that it is down. These are the indicators the RBA is looking for to slow down the increase in interest rates. Please do not believe the media that we're going to get 50 basis points every month until December. It is not going to happen, okay? These factors are going to be very important in how much and how quickly they increase interest rates. So they're going to be watching all of these things here on the left. Now, this bullet point is very important over here. We are seeing a massive slowdown in the growth in China. So China's GDP in the last quarter, you saw our number was 0.8%. China actually only grew 0.4% in the last quarter. That is extremely low for China. Of course, they had lockdowns and other things, and they still got zero COVID policy and so on. But they do have some real issues in China, and they're our biggest trading partner, okay? So, and there is a likelihood of recession or stagflation in the US. Either of these two factors, we've got to watch extremely closely, because if any of those two things happen, and the figures are not far off, okay, it's going to come out in the next few days. When those figures come out, and there is an issue in the US, the biggest economy in the world, RBA and every central bank around the world will take note of that. And they will start discussing how much they need to actually increase, or indeed how much impact the slowdown in the economy in China, in Europe, in US is going to have on our economy. That is a much bigger lever that the world pulls compared to the lever that the RBA can pull, which is a blunt instrument called interest rates, okay? Now, on the right here, I have got the way fixed interest rates are actually set. This is more for information, so I won't dwell on it. But the way fixed interest actually work is, it is based on, so we are here at 1.35, which is the cash rate. Now, these rates here are what we call bank bill futures rates. They are quoted on the Sydney Futures Exchange, okay, out to about that period. When you're looking at a 3-year, 4-year, 5-year fixed rate, it is based on the bond rates and on the what we call a derivative called interest rate swaps. And you build a yield curve based on that, okay? And the banks price their products long-term based on this yield curve. That's exactly how they price it, okay? So if whether they're pricing the deposit product, when you go and do a term deposit and you want a 3-year, 5-year term deposit, which nobody does these days, but if you want a 3 or 4 or 5-year fixed rate housing loan, this is how they price it. They do a yield curve. The yield curve is prepared every single day by the bank's global markets team, okay? This is not the cash rate. RBA sets that. Fixed rates are set this way. When the RBA said that we probably, they made a comment about 3 weeks ago, you saw the RBA governor, the December rate, this December rate was at 4%, sitting at 4%. That dropped from 4% to 3% very quickly when the RBA governor opened his mouth and said that, said something derogatory about where the money market is pricing the product. Now you see that there's interest rates coming down here. So the important thing is that the banks, whenever they do a fixed rate, they can change these. This used to be changed weekly. They change it all the time is the point, okay? So you don't have to worry too much about fixed rates. It's where the money market thinks rates are heading, because banks always hedge that position. Now I did say I'm going to show you what happened in those 4 periods that I was talking about. So I'll start from here. August 94 to December 94, there was a cash rate hike of 2.75% in that period. It's not a long period, okay? And what happened to property prices 1 year after the hike finished? So 1 year after December 1994, what happened to property prices? It went up 0.3%. 2 years after the hike, went up 2%. 5 years after the hike, went up 26%. Property is not a 1 year game, 2 year game, 6 months game, okay? So some of you who have been here recently and you've seen a 25, 30, you've seen land values go up by 60, 70, 80%. You think, well, this is a great way to make money. I'll just keep doing this over the next 5 or 10 years, right? Answer is no. You might not see a 25% median growth in property prices for another 25, 30, 40, 50 years. We've only had 3 times in the last 100 years a property hike of 25% or more in 1 year. Okay, 3 times only. So please keep that in mind. It doesn't happen all the time. The last time was here. Okay, the last time was here. This was sort of 1989, 1990, around then. Now, 1.5% in that period, 14%. I'll let you read that, right? 33 here in 5 years, 64%. And then March, that period. Now, we did not see, we had all these increases here. Admittedly, some of them not in the short period that we're talking about now that the RBA might hike. But we have not seen the highest fall we have seen is here. Okay. And then what happens the year after? It bounces again. And then 5 years time, well, you know what property market's done in the last 50 years. Okay. So I don't need to dwell on that. But the point I'm making here is those people who are predicting those 25% falls and that's making the headline, please question it with facts. Okay, that's the only point I'm making here. Now I'm going to talk, because this is, I said it was going to be about Adelaide. Enough about the economy and what might happen. Hopefully that's given you a little bit of insight. But the reason why what we do at Nivas is we actually value pick what you should buy, where you should buy, and when you should buy. So right now, we are very bullish about property market in Adelaide for a number of reasons. And I will run through that reasonably quickly over the next 10 or 15 minutes. Firstly, the property prices are already up 24.5%, but we think it has more to run, okay? More to run. The auction clearance rate, if you look at city by city last weekend, Adelaide was the only one that was in the 70s, 70% and above. The rest of Australia was in the 50%, okay, or lower. Median house price is still very low, still very low. Now, this median house price is the second lowest in Australia after Perth. So it is very, very affordable still, the median house price there. Gross rentals are still very strong, okay? And this figure is an average. We can show you properties that gets you 6%, 6.5%, even 7%. Rental prices are going up. Adelaide is in the news every week now about chronic shortage in rentals. Because of this, there's a very, very chronic shortage of properties there. So why invest in Adelaide? Some of you, I've got a few slides that I'm going to show you now. If you don't know Adelaide, if you haven't been to Adelaide, hopefully these slides will give you some insights into what Adelaide stands for. It has been recently named as the 3rd most livable city in the world, which means it's also the most livable city, obviously, in Australia. Auckland was first and Osaka was second. Now they use a number of different factors when they're looking at the most livable city in the world. It is not just about the clean air, but it is about you know, per capita, how much you have in terms of sporting facilities. It's about the congestion in your traffic. It's about how many you know, educational institutions you have. It's a number. There's a number of factors that they go through. It's quite a scientific way of working out what is the most livable city in the world. Adelaide has continued to excel in the areas of stability, healthcare, education, and all of these things here, okay? And that's why we have seen the highest level of interstate migration to Adelaide for the past 30 years. Now, infrastructure, very quickly, it boasts now of being one of the epicenters in Australia for education. It's home to Australia's highest ranked universities. Adelaide is now enjoying a reputation as a university city comparable to that of Boston in the US. Health, it is now becoming an epicenter for health as well, okay? So researchers are helping to develop world-leading research with global implications. You know, through COVID, there was a lot of research being done in Adelaide. Breakthrough research, the medical area, and there's significant momentum in this space. And that attracts a lot of people in research, and there's a lot of infrastructure being built as a result. Defense, we'll come to that in a minute. You all know about, you know, with submarines and other things, but there's a lot of other defense work happening in that state. And the environment. So the environment is, they are actually doing significant projects with roads, with making the city a more livable place. There is a lot of lifestyle places in Adelaide. Apart from the Barossa, there is a lot of beaches and the waterfront homes and so on. But very quickly, a few of the things that are happening in the CBD, and please go and Google this for yourself. Don't take my word for it. I'm just giving you the pointers. So the CBD transformation with a redeveloping the Riverbank precinct, the Riverbank precinct being this area here. The Central Market redevelopment is happening this area here. And then there is this massive road project that is going on, Torrens to Darlington. So if you look at this map here, from the north side of Adelaide, this freeway comes all the way down. It is still not connected in this middle here, which is a massive project of $9 billion. And that's going to create 4,900 jobs and bring 4.8 billion in the South Australian economy. So they are connecting the city. They are doing a lot of infrastructure projects, much the same as what we are seeing in Sydney. Innovation is very important. I would like all of you to write this down, okay? Lot 14, write it down and see what Lot 14 is all about, and also the Tonsley Innovation District. Have a look at what these two things actually mean to the city and to the state. But it is getting a reputation now for innovation with these type of companies going in there, okay? Google, Amazon, Deloitte, and so on. So it is a happening city. They're trying to attract a lot more people there. And of course, that is getting dividends for them. Now, did say I will talk about the submarine project. It's a massive project. You all know about it, so I'm not going to dwell on it. There is the Adelaide Airport expansion, 535 million investment for military capability in South Australia. There's a huge military base there apart from the submarine. So there's a lot of things happening in that state. The big story for South Australia that nobody talks about. When we talk about mining, everybody talks about Western Australia. Nobody talks about South Australia, certainly in my experience, okay? And you can say New South Wales, okay, we don't have a hell of a lot in New South Wales when it comes to mining. But when it comes to South Australia, they have some of the biggest mines in the world, okay? So when you look at this area here, blown up, you've got all these massive, so Olympic Dam, which is not far from Adelaide. You've got Woomera. You've got Port Lincoln, which is a deep sea port, which is built up so that all these mines have access to a massive port. Now, and Whyalla is right here. So I'll talk a little bit more about, but you can see the worth of these mines, but I'll talk a little bit more about them. The one I really want to mention to you all, and you must have heard of Olympic Dam. If you haven't heard of Olympic Dam, I'm going to tell you that Olympic Dam is the world's biggest mine when it comes to uranium. You all know uranium is needed for nuclear, whether it is powering submarines, powering missiles, or building nuclear arms, any of the above, okay, or for power. out of all of the uranium mines in the world, this is where Olympic Dam is. That's how big it is. The second biggest here is only that tiny, and it goes down from there, okay? On top of that, you've got, I'll let you read the left here, right? Once completed, it'll be the world's largest open cut mine. It's already functional. It is currently the world's largest source of uranium. It's biggest gold resource in Australia, 5th biggest gold resource in the world, 4th biggest copper resource in the world, has a commercial life of over 200 years. You need this type of industry to make a state thrive. There is no shortage of mining in South Australia, and that will continue for a long time to come, okay? Some of the other large infrastructure projects that are all approved, some of them already built, but you've got the 1.9 billion Women's and Children's Hospital. You've got this one announced just recently, okay? You can see the date on the top. This is Kennard's self-storage and the developer Gurner doing a $1.25 billion project. Here's another big one in the CBD. Then this one announced on the 2nd of June, approval given and announced. A 6-star hotel is going to be built at the Barossa. The projects we're going to be talking about today are not far from Barossa, probably the closest residential you've got to Barossa, which is half an hour away. And that's going to attract a lot of people to this part of the world. I put this slide in because it is illustrating what is happening in Adelaide at the moment. Admittedly, it's 5th of June, okay? But this property in Adelaide in 16 Burlington Street went to auction and sold for almost $1 million over reserve. I never thought I would see a property of this type actually go on that price and that much over reserve in Adelaide. Market has been quite hot there. And what this means is it sort of filters through the market. It's the same thing happens in Sydney. When property prices in Wahroonga, eastern suburbs, and those sought after suburbs actually go up, it filters right through the market. And that's exactly what is going to happen in Adelaide. So Adelaide property market is providing great buying opportunities. We've got historically low interest rates. Listen, I'll continue to say we've got historically low interest rates, okay, until the cash rate goes above 5%. You saw the graph. We are still in a very low interest rate environment. Do not believe what the media is telling you. The media is telling you the sky is about to fall. Nothing like it. We're at 1.35. Sure, it's going to go to 2.5 or 3%. That is still a historically low interest rate environment, okay? And there is high appetite for banks to lend. Demand will continue to be strong. Migration is going to bring a lot of people here. We've got 2 years of backlog, 2 years of backlog. So we're going to get so many people coming here in the next 2 to 3 years. Like I say, property is not like the stock market. You got to have a longer term view. Expatriates and students are buying here. Investors, you could positively get properties in Adelaide. It's cheaper in some places to buy than rent, even now with interest rates going up, okay? Supply is significantly down for those reasons, and I won't go through it. I'll let you quickly read that. Now, cost of construction has been going up. What happens when price of construction goes up? The value of properties also goes up. What happens when you have inflation? The price of property also goes up, okay? Every time we have had high inflation in history, property values actually go up. I don't have a graph for that. Next time I will make sure I have a graph for that. Nobody talks about that, okay? Interest rate is not the only thing. Rentals are heading up and up, chronic shortage. I won't go through that again. FOMO effect. People are missing out. People are missing out. They think they're going to look at other places to buy. One of the reasons Adelaide is still strong is it's very affordable and it's got good returns on the back of chronic rental shortage. So this effect will continue. Business confidence is high. If business confidence was not high in Australia, we would not have more jobs than people, okay? We are at full employment now, and there is a record number of jobs being advertised. They cannot hire people. And that shows you the business confidence. And then we talked about infrastructure. So we are at 0.3. This is the lowest vacancy rate in Australia. I won't dwell on this, okay? Every place is coming down from a year ago. Everyone is coming down. Even the June numbers that have come out are very close to this, which is why I haven't updated this chart. So vacancy rates in North Adelaide, where we'll be showing you a project. This is where it's come, right? This is the peak. This is the peak. And then even through COVID, it was falling, came down all the way to here. And that is because you have got a shortage of supply and the demand has increased. When that happens, you get this type of chronic levels of vacancy rates. So if you think interest rates, if you thought before today that interest rates were the only factor that moves the needle on property prices, you've got to think again. This is the simplest graph I'm going to show you today. Are we going through economic growth? Absolutely. Are we going through jobs growth? Absolutely. These two things are going to translate into wages growth. It hasn't happened yet, but it is going to happen. It's a no-brainer. Population growth, absolutely, we're going through population growth. These four factors are going to continue to increase rental and buyer demand. All of them added together increases in property values. It's not one factor. If there's only one takeaway for you today, it's not one factor. It's not just interest rates. It's all of these factors. Very quickly again, so when you're buying a property, what are the key factors you've got to look at? When I came to Australia 40 years ago, agents told me, mate, it's location, location, location. And I learned very quickly over the years that I've been here, location is very important, but it is not the most, it's not the only thing, okay? It is still my number one. You've got to have an area where population grows. People talk about regional areas. They talk a lot about regional areas. And I say to them, and they ask me, I get asked a lot, where should I invest in the regional area? And I've got given some townships. And I say to them, go and look at the population growth for the next 20 years. The data is available. The data is available, okay? Each of the states have projected the population growth in every single postcode in their state. Go and look at those numbers. If there is very low population growth in that place, don't go there. You need population growth, number one. That is so important. You see who else is investing there and you piggyback on them. Is there a Coles or a Woolies or a Bunnings or a Costco or those type of things actually coming in there? They do much more research than what we can ever do. Okay, they've got bigger teams of people and they know the government wants them to be there. So piggyback on where they are going, okay? And then these things are all very important. I'll let you go through that. Price point is very important. I am not telling you today that you are buying at a low price point, at the lowest price point you possibly could in Adelaide. No, they're already gone through a price growth cycle, but they are not done yet. In my personal view, they're not done for another 6 to 12 months, which is why we think Adelaide is a good place to invest right now, okay? So price is still reasonable and there is significant growth to come over the next 2 to 3 years. Timing is always important, okay? So timing is sometimes just as important as these other two things. So timing, there are certain things I would not tell you to go and buy right now. And that's because that does not give you the biggest bang for your buck, okay? So I keep using this example in my webinars and seminars. People who have bought a 2-bedroom apartment in Rhodes, I have nothing against Rhodes, by the way, 3 years ago, come to me and say, I have not had any growth in the last 3 years and everybody has made money in property. So location, type of property, timing, price that they paid, okay? All work against them. To get the biggest bang for your buck, you've got to value pick. You've got to put your money. You don't invest $1 million every day, 500,000 every day. It's a lot of money. You're not buying a second-hand car for 15,000. You need to do your homework. You need to talk to people who know what they're talking about. Okay, and the developer and builder are very important. So if I've not already given you enough about why you should invest in Adelaide, so I'll reiterate the points. Okay, low vacancy rate, lowest vacancy rate in Australia. Their views per listing is grown a lot. Today, even now, their views, their REA views are very, very high compared to the rest of Australia. It's highly affordable. Median house prices are third lowest in Australia. You can have a look, 619, okay? Still very, very affordable. Only Perth and Darwin we don't worry about, it's a small place, but Perth is the only place which is lower. Adelaide is today where I think Brisbane was about 12 months ago, and there is more upside coming in the next 12 months. Now I'll stop there and I will talk a little bit for the next 3 or 4 minutes. We'll try and cover off, before we get to questions, try and cover off the area called Manopara. Actually, Raj, are you there, Raj?
Did you want me to run through it?
Yeah, Krish, why don't you run through this slide?
No problem. Hey guys, my name's Chris from Nivas Real Estate. Hope everyone's well. Look, further to what Sachin was saying, in Manopara, there is a lot of infrastructure which has recently been spent in the area. So you've got things obviously like the train station. You've got a lot of schools here. You can see private schools. You've got services. You've got Manopara Shopping City. You've got Bunnings not too far away. You know, so there's a lot of infrastructure being spent in the suburb and surrounding. And I guess where we sort of compare it to, if you want to compare things in Sydney, it's kind of like looking at Marsden Park. Basically, it's very sort of similar in the sense that Marsden Park, 10 years ago, there wasn't much, but now more and more is coming up. So in a nutshell, they're gearing up for a big population sort of increase in Manopara. Hence the reason why all these big companies have come in. Yeah, if we could pop through the next slide. Okay, so basically Manopara is about 36 minutes north of Adelaide, right? Now, where Manopara is it's actually, it's kind of like the gateway to the Barossa, as Sachin mentioned as well. So you're about 30 minutes away from there. So you're in kind of a sweet spot where you are in suburbia. You can duck away for a holiday, up north within 30 minutes, or go to the CBD within 35 to 40 minutes. As I mentioned, again, there's a train station in Manopara as well. So if we pop across to the next slide. Now, guys, this is just on a very high level, just to show you an example of what we have. Now, this is basically a 4-bedroom, 2-bath, 2-car home. This property is priced at $517,000. As you can see on the right, it's quite standard in the sense that it is fixed price, very good inclusions. And one thing I just want to touch on now, the builders that we use in Adelaide, obviously there is a lot of scrutiny around builders across Australia at the moment, but the builders we use, obviously Sachin, myself, Raj, the team, we put the builders under a lot of scrutiny. We definitely don't want, we don't want to be dealing with somebody who's going to get into issues and that sort of thing. So the builders we use are sound. They're not massive builders that build 300, 400, 500 homes a year. These guys would build anywhere from 50 to 100 homes. They're more boutique, but they haven't overexposed themselves. And yeah, in a nutshell, they're sound, good quality builders. Now, this is another example of a cheaper package. This is a 3-bed, 2-bath, 2-car at about $452. And you can even go as low as around $420, depending on the land size. So $420,000. So in a nutshell, very good pricing. The rental yields are strong as well. And these estates like Roberts Farm, for instance, Wattlefield is another one we have as well. These estates are master plan estates. So they're going to be well developed with lots of parklands and that sort of thing as well. So yeah, very, very good locations and a good product. Now, guys, co-living this is something we should be explaining more on a one-on-one basis because it takes a little bit of explaining. Now, what a co-living property basically is you'll have a dwelling, let's say a 3-bedroom home, for instance. So this is an example here in front of you. So if you've got a 3-bedroom home, each of those bedrooms will have an ensuite. There will be 3 different tenants living in the property, right? So in a nutshell, what happens there is each tenant has their own lease agreement, right? They have their own space, they have their own, their own cupboards in the kitchen, that sort of thing. The property manager will find like-minded people. So they won't have like an 80-year-old person with a 21-year-old person, and they won't do any of that. It'll be if there's 3 professionals, they'll have 3 professionals, living in the same place. So everyone gets along and so forth. And the beauty of this particular type of home is the yields are very strong, guys. So something at about 529,980, you'd be looking at a yield of somewhere, around the 630, 640 mark on an average, or 6 to 660, you can see that. So strong rental yields. The vacancy rates are very low. So these type of properties, they do rent out very quickly, obviously, as well. But again, guys, we want to go through this with you on a one-on-one basis. If you are interested in Adelaide, we can elaborate on this much further. Now, payment terms are quite favorable. So some of our, well, as you can see here, for this particular project, it's $1,000 fully refundable deposit, 10% deposit on the land, and 1.5% deposit on the build. There are some projects, guys, that we do have in Manapara where to secure the build, it's as low as to secure the land in terms of exchanging contracts, it's as low as $5,000, not even 10%. So guys, I don't want to go into too much detail, but we can have a one-on-one session with myself, with Sachin, and we can go through all of this in more detail. Yeah.
Thanks, Krish.
No problem. Thank you.
Okay, some concluding comments from me. So one of the messages for me today was don't blindly follow the media. The property market doesn't just fall by 20%. Okay, so we do not believe there's going to be any sort of crash with interest rates where they are and where they are heading. If interest rates get to 10%, we might have another conversation. Do your due diligence when you're buying property. Like I said before, you've got to have a long-term view when building a portfolio. The reason why we are proposing Adelaide and proposing these type of properties is because it is a good one to add to your portfolio. Your returns are good, even at today's interest rates, and add another 1% to the interest rates from today, you're still going to be either neutral or positively geared. And there is good opportunity for growth there. So why should you invest in property? Can you retire with super? I will repeat what I say in every webinar that I do. If your house is paid off and you have $1 million in your bank or in your super, you absolutely cannot retire. Because if you have $1 million in the bank and your house is paid off, you are gonna at 2%, even if you get 2% interest rate, that's $20,000 a year. I don't think any of you can live on $20,000 a year. Property does generate wealth, and that is the only reason, the primary reason why Australians per capita are the wealthiest people in the world now. And we've gone past Japan and we've gone past Switzerland, and that is the only reason. So you must buy properties. Most of you listening, husband and wife are working, and you've got a good salary. There is no reason in the world, if you are still in your 30s or even 40s, there's no reason in the world why you cannot build a portfolio of double-digit portfolio, between now and the time you retire. And I think if you have a strategy to do that, I would recommend you diversify and you keep buying in areas of growth, and keep buying where there is value in buying, and keep building the portfolio. Because when you own $5 million of properties, some of you probably already do, and price goes up by 10%, that is 500,000 you doing nothing. If you have $10 million in properties, and it's not hard to build a $10 million property portfolio, and prices go up by 10%, you've just made $1 million doing nothing. That is the position you want to aim for. That's the position you want to be at. And I think there's no better class of asset than properties. I will stop there, and there's some contact details there, and we'll take some questions. And sorry, apologies for going a little bit over time.
Guys, no such thing as a silly question.